Hey guys, this is Sandy. I'm your licensed realtor here in the Central Florida area and also a licensed loan originator as well. Today I want to do a video for you on how does a non-occupied mortgage work. How does a non-owner occupied mortgage work? This is like an investment product and you can use it to start dabble in real estate investment. So when you talk about non-owner occupied mortgages, it's going to relate to mortgages where the owner is not living there. So typically it's for a single family home up to a 4-unit property. So up to a 4-unit property is considered residential. And you could either buy a home, let's say you buy the home and you want to do Airbnb or short-term rental with it. Maybe you buy a multifamily home and you want to just rent it out to tenants. Whatever the situation is, it's going to, once it's residential and you're not living there, then you would need a non-owner occupied mortgage. And there's a lot of different kinds of non-owner occupied mortgages. What are the things to keep in mind? Some of the things to keep in mind is the bank is going to want you to have somewhat of a higher credit score, maybe a 620 or more. I know for DSCR, which is also another non-owner occupied mortgage, they sometimes want a minimum of a FICO score of 640, but 620 you could probably start getting there. You are going to need a higher down payment, and you also are going to need and you also will get a higher interest rate. I need coffee. You're going to get anyway. You will need a higher interest. You are going to get a higher interest rate for the most part. Now, the difference between a non-owner occupied mortgage and a second home mortgage, which sometimes people confuse the two, they're two separate things. A second home mortgage means you're not going to live in the home full time, but you will live in the home for some parts of the year. Non-owner occupied mortgage means you are not living at the property at all. The property is completely being bought for investment purposes. Whether it be a single family up to a 4-family, you're not living there. The most popular product though out on the market today for non-owner occupied mortgages is called a DSCR loan. And the reason why this is so popular is because the bank is going to loan the money based upon the profitability of the property you're buying. What does that mean? It means that if you're going to buy a property and let's say the mortgage on the property is going to be $1,500 a month for an example, then once the debt service covers that $1,500, then that's fine. So that means once your principal, interest, insurance, and taxes is $1,500 per month or less, then the bank is going to use the property for you to qualify. Now, if it's more, the bank is going to require you to do a bigger down payment. And also, if it's more, for the most part, you're going to have to think about having reserves. So the bank might say, okay, how much money do you have in the bank? Whatever the money is, they're going to look at the money to cover at least 20% down payment on the typical loan, a typical DSCR, 20% down payment, closing costs, and they may want to see up to 3 to 6 months monthly payment in reserve. So if the monthly payment is $1,500 per month, they're going to want to see that once you cover your down payment and your closing costs, you have an additional $6,000 to cover 4 months or $4,500 to cover 3 months based upon what they're looking at. For this particular kind of loan though, you want the property to be able to cover the debt service. So when you're looking around on the property, now the thing is to remember, most of the time, if you're buying a property or a building or whatever you're buying up to a 4-unit, if you're going to be doing short-term renting or Airbnb in it, the bank is not necessarily going to look at the income from the Airbnb or the short-term rental, the income potential. They're going to look at what would be the long-term monthly payment. I mean, the long-term tenant's payment. So that means how much would it typically rent for? If you weren't doing short-term rental, what is the typical rental rate for that property on a monthly basis without doing short-term? Meaning if you were to get a regular tenant and rent the monthly house to them, what's that going to be? So when the appraisal goes out there, that's what they're going to be looking at. However, if you're buying a property that's already established in the short-term business and have a track record of a year or two of what that income is, the bank will take that into consideration. So if you're buying a short-term rental property that was already being rented by the owner you're buying it from, and has a year or two of rental history that the owner is willing to give to you, to give to your bank, that means the seller, I should say, the seller is willing to give to you, to give to your bank, then you'll be able to use that as well. But for the most part, the bank is going to look at the monthly rental income for that location. So if you're buying in ABC community, and when the appraiser goes out there, they're going to look to see what is the monthly rental rate in ABC community, right? And that's where it can become very tricky, because if you're buying it for short-term rental, obviously it's going to make more money. But if it's not established and you can't prove that to the bank, they're going to look for what the regular monthly rental rate would be. So that's the difference there. For DSCR loans, most of the time they want you to have a 640 credit score. Most of the time, if the property is making enough rental income, regular long-term rental income, to cover the debt service, then you'll just do a typical 20% down. Let's say you're buying the same property and your debt service is $1,500 per month, but the appraiser came back and said, well, the property would only rent for $1,200 per month, whatever it is, because the appraiser can only go off other properties that are similar that has rented in the past. They can't look at the condition, they can't look at any of that stuff, right? They just go on, this is the figures. So let's say it came back at $1,200 for your monthly rental rate, but your debt service is $1,500. The bank is going to want to cover that gap of $300, right? So 15, 12, it'll be $300 gap. So they might say to you, okay, in order for that to happen, we now have to bring the debt service down to $1,200 a month instead of $1,500. So in order for us to do that, you're going to have to come up with more monthly payment, more down payment to get the debt service to $1,200, because the bank is not going to risk lending money on a DSCR loan where the rental rate is not covering the debt service. And if that happens, where you have to put more down payment to cover that $300 gap, the bank may also say, now we also need for you to have some reserves. Each bank is different, so it depends. There are different lenders that do different DSCR loans, and they have different criteria. But just bear this in mind. So that's what a non-owner occupied mortgage would be. If you buy an apartment building or a commercial property, this would not be the case. Non-owner occupied is only for residential from 1 unit up to 4 units. So a single family home, a duplex, a 3-family home, or a 4-family home. And once again, just want to reiterate this because people get very confused on this. Your monthly mortgage must cover the debt service. And if it doesn't cover it, the bank is going to want you to put more down payment so it covers. Typically, you're looking at 20% down. A lot of time, the interest rate is going to be 1 or 2% higher than the regular owner-occupied mortgage interest rate, so it'll be a little bit higher. Your credit score is going to have a lot to do with that. So if you want a really decent interest rate, you want to try to get your credit up closer to 700. Now, it depends, right? So let's say you're buying a property and it's really producing, and let's say you're 2% above the regular interest rate, but the property could still cover that debt service, then it doesn't really matter because the property is going to cover it. So on the DSCR loan, the property is what qualifies. You still have to have a good interest rate, but you still have to have a good FICO score. But the thing about it is, you don't need to qualify on income or any of that stuff. Of course, the bank is going to want to see your bank statements, and they're also going to want to make sure you have enough income in the bank to do your down payment and all that great stuff. But for the most part, you're not qualifying, the property is. So once you have a great credit score and you have enough money in the bank to prove that you have the down payment and to cover the debt service, and the property will cover the debt service in the eyes of the bank, then you're good to go. Now, if you didn't want to do all of that, you could buy you could just do a regular owner occupied, and then you'd have to live in the property. So if you were buying a 4-family unit, then you'd have to live in one. As long as you're living on premises, you could do an owner occupied mortgage. But if you're not living there, even though it's residential, you have to do a non-owner occupied. Or if you're going to be living there, like maybe you have a home in Florida and you're buying one in New York or vice versa, that would be a second home mortgage, and that would be a whole different ballgame. If you do a second home mortgage, it doesn't qualify for income property because it's a second home. Some banks frown upon the idea if you having a second home and you rent it out on Airbnb or whatever it is. They have a criteria as to how long you could rent it for if it's under the category of owner occupied. I hope this helps. Our information should be somewhere up here or somewhere below. You can always call and text, ask for a complimentary consultation. But that's kind of how that works. Hopefully I